Okay, CPI, 30 seconds from on deck. Here are the expectations. Write them down or remember them. CPI month over month, 0.4. CPI core month over month, 0.4. CPI year over year, 6. And core year over year, 5.5. Joe Biden gave us a heads up that this CPI report would be good. He was confident this report would be good. Did Joe Biden get a leak? Does he know something we didn't? Here we go. And CPI is 0.4. It's a match on headline month over month, 0.5. A little hot on core, not great. CPI year over year matches 6.0 and core year over year matches at 5.5. So across the board, it's basically a match with the exception of core. Core comes in slightly hot, not ideal. Real average hourly earnings year over year, negative 1.3%. Real average weekly earnings year over year, negative 1.9%. If you speculated on this one with options, I'm not sure this is going to be enough to really push us in one direction or another. That core number coming in 1/10 hot though, if anything is slightly bearish, that tilts slightly bearish, that moves us from a prior release of 0.5 on the month over month down to 0.4 along with expectations, but we go from 0.4 on the prior release on core with an expectation of 0.4, unfortunately up to 0.5. On an annualized basis, that is in line with a 6% annualized inflation rate. Now, unfortunately, that's not ideal. That's not where we want to be. However, the other numbers all matching expectations. The fact that we're coming in at 6% year over year, 5.5% core, fine. I would say this is clearly evidence to me that we are likely to see the Federal Reserve stay 25 or potentially even 0. We'll talk about expectations from different companies in just a moment and different analysts in just a moment. But to me, this is probably enough data to really say, look, we don't need to be thinking about a 50 BP hike. We're like inflation is slowly trending down. It's not plummeting, right? It's clearly not plummeting inflation when we have core increasing 0.5 in January here, and then this is the last report. Let's go ahead and get the new one. That means the BLS hasn't updated their website yet. But anyway, we get 0.5 on the headline core. Waiting for here we go. There we go. There's the new report. Okay, this is the one released. Yeah, this is released March 14th. Okay, interesting. Let's go ahead and grab this in here. That's the same document. Okay, all right, whatever, CPI. Oh, we'll go ahead and throw this in here. But again, slightly hot here. I would say this probably reiterates a 25 BP hike. But if the Fed is really concerned about the banking system, it is entirely likely that the Fed could pause. I think it's 25 BP more and done after this report. I don't think this is a report where we could say, okay, yeah, the Fed should pause or cut. This is probably another 25 BP. We've bailed out the banks. Everything's good. Let's keep going. One more 25, and we're on the right trajectory. That's the idea here. So let's see here. Index. So this does, again, show, yeah, this is the March 14th report right here. Total for all items less food and energy rose 0.5% in February after rising 0.4 in January. That's good. Remember, this is the February report released in March. Let's look at some of the details that we have over here. So food increased 0.4% in Feb. At home rose 0.3%. 5 of the 6 major food groups increased over the month. Not ideal, although then again, it's okay if things increase as long as the increase is a slow rate. Index for non-alcoholic beverages increased 1% for February. On the Mormons, back at it again. Meats, poultry, fish, eggs fell 0.1% over the month. Okay, cool. So a little bit of a mix over here in food. Fine. You've got energy. Energy index fell 0.6% in Feb. Fantastic. Natural gas decreased 8% over the month. It shows you how volatile this stuff is. Fuel oil rose 9.2% over the last 12 months. Okay, whatever. Let's get out of the volatile and let's go to the most important ones. So the most important ones, in my opinion, are the core services segments. So I'm going to go ahead and pull up the detailed chart. And at the bottom of the CPI release, you can actually get the detailed expenditure categories chart. And we want to look here because really what we're looking for, and we know what Jerome Powell is doing. He's probably already done this because he gets these reports early. It's not fair, man. I want to get the reports early too. How am I supposed to YOLO my options, man? Anyway, over here, what do we have? This is what we want to pay attention to. So just so you know how this chart works, the far right column is the seasonally adjusted month over month percent. This is generally what we use. If you want the unadjusted, you could use the second percent column over here. But really, we're going to be looking at the far right one for the seasonal adjusted. We're going to go straight to services over here. See, look, this is just not ideal. Why? Why is water and trash collection and the services for that, why is that up 0.8%? That's too hot. That shows you services, just too hot. Domestic operations, minus 1.3%. That's good. Moving, storage, freight, minus 3.2%. Fantastic. We want to see negatives. Good. Good. Medical, good. Negative 0.7. Good. Professional services, negative 0.3. Good. Physician services, negative 0.5. This is good. Dental services, 0.1. That's okay. 0.3, little bit hot, not bad. Hospital and related, thank God, comes down to 0.1 from 0.7. That's good. More of these services coming down, good. Where are we sticky? Look where we're sticky. Oh, thank God. This is actually this is good, folks. Rental inflation is sticky. Come on, man. Everybody and their mom is expecting rental inflation to come down. So this is good. It's just, this is probably one of the biggest lagging indicators you have, right? Is rental inflation, 0.7% on rent of shelter. Primary residence coming in with a 0.8. That's hot. 2.3 for lodging away from home. That's not ideal. That's like your Airbnb and your hotel index here. Lodging away from home, really expensive here, up 2.6%. That's hot. Owner's equivalent rent, still hot. Remember, rent of shelter is like over 32% of CPI and over 25% of CPI. So when you see that this is sticky over here, but you know that this is going to be coming down thanks to leading indicators, it's a good thing, right? Look at the weights over here. Rent of shelter, 34%. That's right, they actually increased the weight for rent of shelter from 32% to 34%. So they actually made it even more painful. And the biggest component of that is owner's equivalent rent at 25%. So this rent section staying up is the hottest part here. Actually, look at this. Other lodging away from home, that's the part that really ran up, is barely 1%. So hotels, folks, barely 1% of CPI. Who cares if hotels get more expensive? Just bring owners' rents down. That's it. That's all it's going to take for inflation to start plummeting. Because look at all this yellow here. This yellow is actually good. These are nice negatives in services over here. Health insurance, let's go. Minus 4.1%. A little more expensive to take care of elderly and invalids. Dude, who still uses that phrase? The CPI is... That's racist. Okay, no, that's not racist, but anyway. So transportation services, 1.1% to the upside. That's hot. That's not ideal. That's a little hot. So transportation services, what's driving that? Well, what's driving that is motor vehicle maintenance and repair. And that's only up 0.2%. Motor vehicle body work. Guys, stop working on the body. 0.9% over here. Motor vehicle maintenance and servicing, 0.5%. Motor vehicle insurance. Dude, insurance has been skyrocketing. It's a pisser, man. Everything's going up with insurance. Look at home insurance, too. Anyway, 0.9% over here. Parking and fees. Okay, that's not that big of a deal. Public transportation. Come on, man. The government should be able to rig this one. 3.2% for public transportation. Good Lord. How are we back to airfares going up? Now, airfare is only a 0.57% weight. So again, it's a drop in the bucket compared to rents. But geez, Lord, 6.4% on airfares, and you just destroyed the down of the last 2 months. It's actually interesting. Morgan Stanley had a heat map of airfares, and they're like, we think more planes are flying. Now, maybe that's just my plane. People like, Kevin, you're not gonna fly enough to justify a plane. I flew 70 hours in the last 30 days. If you annualize that out, that's like flying 840 hours in a month. That's insane. Anyway, intracity transportation down. Okay, so in other words, it's probably the outside of city transportation. Well, it's really airfares that are driving this transportation up in public transportation. Recreation services, that's still hot. Why is recreation coming in so hot? That's not ideal. Recreation coming in at 1.2%. I mean, that's like 12% inflation. So that's not great. Cable and satellite streaming, video disc, who still buys that? Pet services, Interestingly, we saw leading indicators, even a course member. Remember, we got a course member coupon code linked down below, St. Patty's Day. Price will be going up after it. But anyway, a course member emailed me and said, hey, I got a pet shop. We're still raising prices the first few months of the year. So what did I do? I went and looked at Petco and the other pet companies' earnings calls, and they're like, yeah, we still have some leftover price increases coming for the first quarter and first half of 2023. But after the first half of 2023, we're done. We're not going to raise prices anymore. Now that to me is actually really interesting because it's a leading indicator. Leading indicators matter. What we're looking at right here is a little bit lagging. What are the leading indicators saying? The leading indicators are saying, yes, there's still a little bit of pipeline inflation. Yes, Walmart has still had to raise wages. Yes, McDonald's still had to raise wages a little bit. But what is the leading information? Well, the leading information is, don't worry, inflation is trending down. Yes, maybe a little bit left in the pipeline, but that's normal. Okay, so I'll also tell you what the suits are saying in just a moment. Education, comm services, that's nothing, 0.2%. Honestly, a lot of these services are coming in pretty soft. Postage and delivery, 0.2%. Tuition in schools, 0.1%. This is actually fantastic, folks. This is actually a pretty good report. Other personal services, that's pretty hot. 1.1%, that's not great. That's going to be like your haircuts. That's probably the last place you would expect to see softness. Miscellaneous personal services like legal services up 1%. That's not great. Laundry, apparel, financial services. Man, those finance people raising their prices all the time. Dang it. By the way, have I mentioned that we're raising the prices for the programs and building your wealth link down below? Use that St. Patty's Day coupon. Get in before we raise the prices. You get a price guarantee once you're in, so you get the best price for life. But anyway, I have to say personally, first glance at this is actually a very good report. And what? Alcohol getting cheaper. Oh, damn. Who wants to go out? It's on me. Alcohol going down 0.3%. Other goods, a little hotness there on goods, 0.7 on other goods, but that's like tobacco. Sporting goods, 0.2. That's fine. There's the pets product. We knew that would be a little hot. And that's sort of the pipeline we just talked about. Education comm coming in negative 0.1. Look at the vehicle segment over here. Used cars and trucks still coming in with a negative 2.8, even though leading indicators are suggesting this should be actually rising. I think the seasonal adjustment is really, well, even unseasonally adjusted, it's negative over here. So I don't know if there's a lag here because we do kind of expect used cars and trucks to start popping again, but so far they're quite negative over here. Now I'm going to jump into what the suits are saying. I want to get their look. How the hell is apparel up 0.8%? What is this? Are you telling me Lulu has pee-pee again after I thought they had no pee-pee? What is this garbage? Household cleaning supplies, 0.5%. Tools and hardware and outdoor equipment, stop spending money, 2.7%. All items less, okay, that's fine. What do we got over here? Window floor coverings, minus 1.3%. Hey, that's good for house hack. Living room furniture, that's good for the Airbnb hack. Negative 0.8%. Furniture bedding, only 2%. That's fine. Okay, good. So this appliance is popping up a little bit. Okay, not ideal, but all right. I'd say overall, this is actually not a scary report. Let me see what the suits are saying. To me, this is actually suggesting that we have some disinflation. It's lumpy, right? It's lumpy. It's like, some of the things that were falling last month are rising now. Yes, it's lumpy. But the biggest thing that's keeping this up, the only thing keeping this up is the Viagra of housing. That's it. Otherwise, this thing would be so soft. It would be the softest CPI report you've seen in years. Anyway, what are the suits saying? Underlying U.S. consumer prices rose in February by the most in 5 months. That's the 0.5%. An acceleration that leaves the Fed in a tough place as it seeks to thwart rapid inflation without the turmoil of the banking sector. Yes, Bloomberg intelligence chief says data is just strong enough to think it clears the Fed for 25 BP. That's what I said the first minute of this video. I think this nails down 25 BP. I agree. I think we've got one more 25 BP in us, and that's probably it. Core services ex inflation, while stubbornly high, ticking down. We're down now to an annualized increase of a 6.14%, down from 6.2%. This is actually good. So I like this. So you could see how slow it's moving down. Look on screen now, please. You can look how slow it's moving down, core services ex inflation. But you know what the good news is, folks? You know what this line right here says? No Paul Volcker. No Paul Volcker. No Paul Volcker. That's actually important because remember, meet Kevin, for the longest time has had the opinion that yes, we are going to go through hell, but we are not going to go through a Paul Volcker. There is no evidence of a wage price spiral. There is no evidence of a spiraling out of control of core inflation, even excluding shelter. Yes. Is it sticky? Is it coming very slowly? Yes. We don't want it to come down very slowly. We want it to come quickly, but it's taking longer. But that's okay. Higher for longer is not the end of the world. It doesn't mean Paul Volcker. It means Nike swoosh recovery, baby. Another report to reiterate Kevin's bias of the Nike swoosh recovery. It's true, but look, I'll tell you if things are going anti my thesis. But so far, this is right along thesis here. Bank of America says we're in a stress event right now, blah, blah, blah. I want to, by the way, tell you what other banks are saying in terms of whether they think we're going to get a cut, flat, or hikes. I'm going to give that to you in give me 1 minute. I want to look at a couple more things. Super core month over month, moving from 0.36 in Jan to 0.5 in Feb. Not ideal. That's that 6% rate, that 6% annualized rate. Again, we'd like to see that coming soft, but again, no Paul Volcker. Yes. Higher for longer, but no Paul Volcker. Okay, those were all just the data report. Okay, so I've already gone through this. One last thing. Core goods inflation cooled. Core service inflation is marching higher on an annual basis. Yeah, but that's annual. Okay, we just looked at core services month over month, which is more important. Yes, annual is still technically lapping numbers and still trending up. Not a biggie. Okay, now, what were the suits saying before this report? Now, I want you to keep in mind, what I'm about to read you is not another coupon code pitch. It is not suggesting that you should go to metkevin.com/life to get life insurance in as little as 5 minutes, or go to metkevin.com/Weeble to get yourself free stonks. It is simply to say that Bank of America expects a 25 BP hike in March. Citi still expects a 50 BP hike in March due to a hot hot jobs report. And this probably reiterates it. The CPI report we just got reiterates it. Why? Because guess what? CPI called it, or Citibank called it. Citibank said, we actually expect core CPI to come in hot at 0.5% month over month. Guess what? It came in at 0.5%. So Citibank actually thinks the 0.5 that we got that we just got on CPI reiterates a 50 BP hike. I don't think so. I think 25. I think we got one more and done. One and done. Wham, bam, thank you. All right. Barclays expects a pause or a 25 BP hike because of the banking stress. In my opinion, after the CPI report, it reiterates 25. Goldman expects a pause due to the plummeting, basically, of yields. They think the market agrees with them. So Goldman is expecting a pause. JP Morgan expects a 25 BP hike. Credit Agricole expects a 25 BP hike. Deutsche Bank expects a 25 BP hike. Now here's the interesting. The more research expects a 25 basis point cut and halting balance sheet reduction. Boy, that's a mouthful. They actually think, no more research, actually expects a 25 basis point cut, and they think the Fed is going to pause quantitative tightening because of the Buy the Effin' Fed Pivot program. It's not actually what it stands for, the BTFB program. Anyway, some people are calling it that. But anyway, no more research thinks the BTFP program is insufficient to maintain stability in the financial system. As a result, the Fed is actually likely to cut by 50 basis points and stop QT. Crazy. They're the only ones saying that. Jefferies expects 25 BP regardless of whether CPI comes in slightly hot or slightly low. Okay? TD Bank thanks 25, thanks to the Silicon Valley Bank program. TD Bank went into this thinking that core services remain strong and that disinflation from core goods is fading. Yes, that's what we saw. Conclusion, most of all of the analysts on Wall Street are reducing their expectations for a Fed hike to 25 BP. Some of them are going wild. Yeah, analysts gone wild. Oh, that sounds like a fun party. Anyway, they only no more research thinks we're going to have the potential of seeing a 25 BP cut. Now, what is the market saying as of minutes ago? Well, the market is suggesting that we're probably sitting at about a 91.5% chance of a 25 BP hike and only about an 8% chance of a pausola. What is the terminal rate expectation showing? Let's take a look at this. So let's see here. Terminal rate expectation. Up. Now, up to... Oh my God. What a roller coaster. This is stupid. This is just stupid. 4.95. Okay, why am I frustrated and saying this is stupid? Because look at the chart. Look at this nonsense. That's what this is, folks. It's nonsense. We literally sat at like 4.9 to 4.95, right? We literally sat right here for what? 4 or 5 months? This is like September, October, November, December. It started rising in well, it really started rising in February, so maybe I'm a month off. But anyway, say whatever, October, November, December, January. Basically for 4 months, we were stuck at 4.9. Then we had these hot January reports and we went to hell. And then we had a banking crisis and we came back from hell. And look at where we are now. This is like the most flip-floppery market I've seen in my life. Look at this. We're literally where we were sitting forever. What a joke. What a joke. We're right back to where we were sitting forever. All the drama of February and the last 8 weeks is basically like, JK. Good Lord. Okay, what about Goldman Sachs financial conditions? And then I want to look at inflation break-evens. Let's take a look at how people are reacting over here. So, inflation break-evens, what do they say? Goldman Sachs financial conditions index sitting at 100. That's actually good. They're tighter than where they were at the end of January. They're not as tight as what we saw in September or October, but they're good enough to where I think Jerome Powell says, hey, look, financial conditions are tight. We're good. We could do a 25 BP and chill. You know, it's like Netflix and chill, except, you know, in Fed world, it's 25 BP and chill. Let me show you that chart. So look over here. If you zoom in, okay, so here's Jan. Look how low we got in terms of financial conditions. When we got the hot jobs report, guess what Jerome Powell said when we got this spike? Oh, hot jobs report. No, it's not a problem. You know, financial conditions already reacted to that. That was the reaction he was talking to. Look at what we ended up getting. I mean, it is entirely possible that with the financial conditions this tight, the Fed could pause. I think it's unlikely. Dude, you know how many people yelled at me on Friday when I said, I think this banking crisis makes it more likely for us to have a pause than 50 BP? That doesn't mean I think a pause is more likely than 25. I think 25 is most likely. But I said immediately, 25 most likely, maybe pause, but no more 50 after the banking crisis. People got so mad at me. Now all the analysts are saying it. Anyway. Okay, now we have to look at the 5-year break-even. 5-year break-even. By the way, thanks for being here. I like hanging out with y'all. It's really cool. I know it doesn't seem that way because I'm all alone technically. But really, it's like we're at like a Super Bowl together. Maybe not a Super Bowl, like a concert, 17,000 strong concert, and you got literally some dude wearing a Christmas sweater. Y'all showed up to a concert with some dude who can't sing, a Pokemon and RuneScape coffee mug, talking about inflation. Man, who's more weird, you or me? All of us. Okay, what do we have over here? But we could be weird together. So what do we have over here? We have, what is this? This is the 5-year break even. Okay, all right, that's okay. That's okay, look at that. Pretty stable over here. I mean, that's probably wouldn't have it any other way. That's probably average of what we've seen since September. I mean, let's draw some lines here. I mean, who doesn't like drawing lines on sticks? Okay, so let's see here. So we did not hit a higher high here. That's good. We did hit a higher high compared to October. But are we continuing the downtrend? I mean, somewhat. You could kind of say we're continuing that downtrend. I mean, if I draw the line here, it's better. It's not as strong as the downtrend that we had, which was probably more like this. What if I draw... You know, it really shows we're definitely above median here. See, this was more of a solid downtrend right here, and we're certainly above that. You know, we should be about 10 bips lower right now, just based on this trend right here. So, you know, this is really consistent with higher for longer, but it's certainly not a Paul Volcker. Paul Volcker would look like this. I guarantee you, if we had inflation that looked like this, or break-even expectations that looked like this, I guarantee you, we'd be at 10% interest and we'd be getting Paul Volcker. This is not a Paul Volcker. This is a higher for longer buy the effing dip. That's what it's telling you. It's buy the dip because it's just slowly going to trend up in a Nike swoosh style recovery. I know people get mad at me also for saying that. But then again, you know, I've gotten to the point where people just get mad at me forever. I don't care anymore. But anyway, yeah. So I have to be very clear about this because people hear Nike swoosh and I think they just see this. I think the better way to look at this is probably something like this and then like this, but this being very, very volatile. But I personally think that we're going to look back and say, wow, that year to 2 years period of time between mid-2022 and maybe, you know, the end of 2023, that was a bitchin' time to invest. You were able to invest at pretty reasonable valuations. Good thing I signed up for Meet Kevin's Stocks and Psychology of Money and Zero to Millionaire Real Estate course for the elite hustlers to learn more how to make money as an entrepreneur or as an employed person. I learned everything I need to know about LLCs or tax benefits or whatever because, yes,